Hey everyone, welcome back to Corporate Decoder, the place where we unravel complex financial filings to uncover the hidden stories within the numbers. Get ready, because today we're diving deep into Granite Ridge Resources' latest quarterly report, and trust me, there are some interesting movements in their oil and gas game. Alright, let's get right into the juicy stuff, the financial tables. First up, we're looking at their condensed consolidated balance sheets as of mid-2005 versus the end of 2024. The property and equipment, particularly the oil and gas properties, have seen a significant jump from about 897 million at the end of 2024 to nearly 989 million by June 30, 2025. That's an increase of roughly $92 million. This tells us they've been busy investing in their core business, likely through acquisitions or new drilling projects. Now let's talk about debt. Their long-term debt has also climbed from 25 million to 2075 million. This is a $70 million increase, which aligns with their increased investments and suggests they're using a mix of operating cash and borrowed money to fuel their growth. Looking at their equity, we see that additional paid-in capital went from around 6055.5 million to 656.5 million, a slight increase. This is often where money from stock sales or options is recorded. It's pretty stable, which means they haven't been aggressively issuing a lot of new stock lately. Their retained earnings, however, have seen a nice bump from 16 million at the end of 2024 to over 22 million by mid-2025. That's about a $6 million increase in just 6 months. This is a good sign, showing they're making a profit and holding onto it. Overall, their total assets have grown from about 1.036 billion to 125 billion. This reflects that investment in properties and a generally healthier financial picture. Let's quickly glance at the liability side. Their total liabilities increased from about 401 million to 462 million. This is driven by that increased debt we mentioned earlier, but it's important to see how it compares to their assets and equity. And their total stockholders' equity has also risen from around 635 million to 642 million. This is positive, as it means even with more debt, their net worth has also grown. Moving over to the statements of operations for the 3 months ended June 2025 compared to 2024, we see some interesting trends. Their oil and natural gas sales jumped significantly from 90.7 million in 2024 to 109.2 million. For the same period in 25, that's a solid 20% increase. This is directly tied to higher production, and despite lower prices, they're selling more volume. Following that trend, their depletion and accretion expense also went up from 41.6 million to 53.4 million. This makes sense, as more production means you're using up more of your reserves, which is accounted for as an expense. Here's where it gets really interesting. Their gain on derivatives has swung dramatically from a loss of 785,000 in 2024 to a gain of 23.9 million in 2025. This is a huge swing, and it's mostly driven by changes in the value of their futures contracts on oil and gas from the result of all this increased sales and beneficial derivative movements. Their net income soared from 5.1 million in 2024 to a much healthier 25.1 million in 2025. That's almost a 5-fold increase, which is fantastic news for shareholders. Now, looking at the 6-month period from January to June 2025 versus 2024, the picture is similar but even more pronounced. Total revenues climbed from 179.6 million to 2032.1 million. Yup, a 29% increase. That's driven by selling more oil and gas. And that depletion expense also climbed from 82.5 million to over 101 million, reflecting that increased production. Their net income for the first half of the year more than doubled, going from 21.3 million in 2024 to 34.9 million in 2025. This shows a strong first half for Granite Ridge. Let's look at cost lease. Operating expenses went up from 13.7 million to 20 million for just the quarter, and from 29 million to 36.4 million for 6 months. While it looks like a big jump, relatively speaking, it's tied to having more wells online due to acquisitions and drilling success. General and administrative costs also rose, but it seems a chunk of that increase in the quarter was due to severance expenses and capital market activities, so I expect that to potentially normalize. One thing to note is their weighted average shares outstanding is pretty stable, hovering around 132 to 135 million. This means stock dilution hasn't been a major factor impacting their earnings per share growth. Now, this is interesting. They reported a loss on equity investments, specifically from their stake in Vital Energy. They divested some shares in the second quarter of 2025, resulting in a realized loss of $10.5 million. But this was partly offset by an unrealized gain on the remaining shares, so it's a bit of a mixed bag there. Let's shift gears to liquidity and capital resources. As of June 30, 2025, Granite Ridge had about $275 million in debt outstanding and approximately $103.4 million in available liquidity. This includes cash on hand and their credit facility availability. They recently amended their credit agreement to increase their borrowing base and elected commitments from $325 million to $375 million. This gives them more financial flexibility, which is good news, especially with their ongoing investments. Looking ahead, they're budgeting around $400 to $420 million for capital expenditures in 2025, with about $120 million of that for property acquisitions. This shows a continued aggressive investment strategy. They're funding this with operations and their credit facility, and they believe they have enough to cover their needs for the next year. Now, it's important to remember that, like most companies, Granite Ridge is forward-looking in their statements. They're talking about future plans and expectations, but as this note cautions, actual results could be quite different. Factors like volatile commodity prices, supply chain issues, and geopolitical risks could really impact their performance. They're basically saying, expect the unexpected Einkang Khan. Let's talk about pricing differentials for the quarter. Their oil prices were at a discount of about $3 per barrel compared to the benchmark NYM's price. That's a bit of a hit, but for the 6-month period, the differential was a smaller discount of around $3 per barrel. This indicates market conditions where buyers are getting a bit of a break. On the natural gas side, their prices were also at a discount, but the gap seems to be widening slightly in the recent quarter compared to last year. The 6-month differential suggests a bit more stability. Looking at the production table, we can see a significant jump in their oil production for the quarter, up to 1457 MB from 996 MB, a pretty good increase. And natural gas production also rose from 6,643 mmcf to 8,500 mmcf. Overall, their production in oil equivalent BOE increased by about 36% for the quarter compared to last year. This growth is what's driving those higher sales numbers. Their realized price per BOE, excluding derivatives, was about $43.12 in 2024, but dropped to $38.1 in 2025. That's a pretty noticeable slip in the underlying price they get for their product. But here's where those derivatives really shine. The effect of gains on settled commodity derivatives per BOE is quite beneficial, making up for that drop in underlying prices. You can see it increase their effectively realized price significantly. So what's the story here? Granite Ridge is aggressively investing in its assets, and it's paying off in terms of increased production and sales. Their active use of derivatives is also a smart move, buffering them against the wild swings in commodity prices, especially with oil prices being lower in the first half of 2025 compared to last year. The company's growing retained earnings and increased asset base are clear strengths. However, that rising debt level is something to watch. It's manageable now, but any significant downturn in oil and gas prices or unexpected increase in costs could put pressure on their financials. The company's reliance on third-party operators also introduces a layer of risk. Beyond that, the constant risk of commodity price volatility remains a major factor for any energy company. Scroll now, looking at these results more broadly, Granite Ridge appears to be executing its growth strategy efficiently. The increased production is a testament to their investment decisions, and their hedging strategy is proving effective in a challenging price environment. The jump in net income is particularly encouraging. They're definitely playing an aggressive growth game, and for now it seems to be working. However, stakeholders should keep a close eye on how they manage their debt and navigate the ever-changing energy market. Alright, that's our decoded look at Granite Ridge Resources' quarterly report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep internal company dives. Don't forget to check out our Discord community linked in the description below for more discussions and early access to content. Thanks for watching. See you next time.